Good afternoon, everyone, and welcome to today's webinar. My name is Declan Kirby, Chartered Financial Planner here at Henwood Court Financial Planning, and today I will be explaining the upcoming changes to the Portfoliosense Vantage portfolios. Unfortunately, Paul Bradley, our internal investment manager, can't be with us today. He's on bereavement leave and he sends his apologies. I envisaged the presentation to take approximately 30 to 40 minutes, in which I will cover the proposed amendments to the Vantage portfolios. If you have any questions in relation to the presentation, hopefully you should be able to type them in the Q&A box on the Zoom account application. If I'm unable to answer any of your queries at that point in time, do not worry, we'll take these away and come back to you directly with a clear and comprehensive response. Next slide, please. Okay, so what will we cover in today's session then? Well, firstly, we're going to recap on the Portfoliosense investment strategy, okay, and the principles that underpin it. Next, we'll look at the first major upcoming change to the portfolios and the introduction of environmental, social, and governance exposure. After that, I will outline what new factors we will be incorporating and highlight why we will be removing the Global Property Fund. After that, we'll look at the new fund managers, okay, and finally, we'll finish with a Q&A session. Next slide, please. Okay, so let's start by recapping on Portfoliosense, our internal investment strategy. First and foremost, the media would like to have you believe that a successful investment experience comes from picking stocks, timing your entry into the market, and of course, exiting as well, making accurate predictions and outguessing the market. We think there's a better way. It's true that some people might get lucky making bets on certain stocks or sectors, getting in and out of the market at the right time, or correctly guessing movements in interest rates or currencies. But pinning your hopes on luck is simply not a sustainable strategy from our perspective. It's speculating, not investing. An alternative approach, our approach, it may not sound exciting, but it's far more disciplined and increases your chance of a successful outcome. It essentially means reducing the influence of fortune as far as possible, taking a longer term view and considering your own needs and risk appetite. We're very proud of our investment strategy Portfoliosense, both in terms of the philosophy and the historic investment returns that has delivered for our clients. We're about to embark on, I guess, the next evolution of the Vantage portfolios, which are designed to future-proof them, reduce volatility, and increase future returns. Next slide, please. So Portfoliosense is a dependable, cost-effective investment strategy born out of robust scientific research, okay, based on capitalism and how the markets work. Our scientific approach is measurable, transparent, aiming to optimize investment markets and deliver long-term outperformance. Remember, we're independent financial advisors with access to active managers if we want to go there, niche discretionary fund managers. However, we choose to adopt an investment approach which is more evidence-based. We cannot control markets, that's our true belief, but we can control costs and we can implement hugely diversified strategies designed to optimize returns. So our strategy is dependent, transparent and logical. Next slide, please. Okay, so let's quickly recap on, I guess, the principles of investing, our investment principles, which underpins Portfoliosense. So what are these principles? First and foremost, invest on purpose. So there must be a purpose with regard to investing in order to meet your objectives. Next, maximize your return by investing in equities. Okay, equities is where the capital growth will come from. Invest for the long term. Investing for the long term is important because it helps you ride out short-term market volatility, like what we've seen over the last 12 months. Anything other than medium to long-term investing, from our perspective, is speculation. Retain some cash, number 4. We have always and we will continue to advise clients to hold sufficient cash to meet short-term needs. Thus, when investment markets fall, and they will again, of course, that will happen at some point in the future, by holding enough cash, it enables you to put your head in the sand and wait for that market recovery, which will come. Without holding enough cash, you run the risk of needing to draw on a portfolio when it's down and in turn potentially realize losses. Number 5, keep emotions in check. The biggest single threat to a client's successful long-term investment performance is themselves. There's various studies which prove this. Keeping emotions in check when markets are falling is a very challenging thing to do, but it is crucial. Finally, track, don't pick. Portfoliosense does not aim to guess which way the market is going to move, also known as active investing. Instead, we prefer to follow an evidence-based strategy, which is lower costed, measurable, honest, and I guess it's got the evidence to back it up. That is the route we choose. Next slide, please. Okay, so I guess first part of the session about what's coming to the portfolios. What is the first change? The first change is introducing environmental, social, and governance investment exposure. Okay, so we're going to look at this now. This is the first thing we're going to talk about in relation to the changes. Next slide, please. Let's start by defining what is ESG investing, what is environmental, social, and governance investing. ESG investing is introducing responsible investing to portfolios, okay, across 3 metrics: environmental, social, governance. It essentially screens out companies that do not meet these principles. For example, screening out companies which do not meet carbon emission standards. It excludes sectors such as weapon manufacturers, nuclear weapon producers, civilian firearms, non-renewable energy. That's what we're trying to exclude moving forward. We believe that a failure to adopt ESG screening moving forward will result in lower long-term investment returns, and we'll come to the data on that later on. ESG investing is now firmly entering the mainstream. I'm sure you've read about it. It's a more responsible way of investing without impacting long-term investment performance. Essentially, by using our capital, we can force companies to change their operations to address investors' concern, who are essentially owners of these companies by owning shares in them. So that is the aim there. Next slide, please. So the 3 pillars of ESG investing, as I mentioned earlier, environmental, social, and governance, then what are they? You can see on the screen in front of you, these are some of the things they're trying to tackle, some of the aims they're trying to meet. Environmental, it's essentially trying to produce more output with less natural resources, being energy, water, waste, and pollution. Social, trying to improve relationships with key stakeholders, employees, customers, suppliers. And then governance, aiming to reduce risk through board oversight and risk controls. Next slide, please. Okay, why ESG investing? Why are we implementing it? At the heart of ESG investing is a simple idea that companies are more likely to succeed and deliver strong returns if they create value for their stakeholders, employees, customers, suppliers, and the wider society, including the environment, not just the company owners. The introduction of greater ESG exposure provides investors with the opportunity to combine a passion for ethical behaviour with a positive financial return. In short, we truly believe we have built a better portfolio for you. I guess if I could summarise ESG investing and why we're doing it, it's to future-proof our portfolios, to be more responsible with our investments via our capital, and to enhance future risk-adjusted returns. Remember, we're not prioritising ESG over our investment philosophy and principles, being evidence-based, being low cost, being highly diversified. It is just going to accompany the strategy. Next slide, please. A question you're probably all thinking or want to ask: will it impact performance? We will always be led by the research and evidence, and in short, the answer is no. Adopting ESG exposure to your portfolio, our view, our belief looking at the evidence and the data, is that it will not impact performance, and in fact, it is likely to enhance it. Okay, there is clearly a positive relationship between ESG and returns, and there has been various studies and scholars that prove that. ESG as a positive impact on performance is common sense. Strong ESG practices help to reduce material financial risks and avoid companies that become stranded due to regulation, environmental change, while seeking out those with solid potential. That's the aim here, and that's why we're doing it in relation to performance. Okay, so let's look at some of the data, please. Next slide. Okay, so the graph you can see in front of you, let's look at this data. We have generated some simulated data running our current UK bias portfolio, okay, versus the ESG equivalent. So our existing portfolio is the orange line, stated Vantage UK bias 100. So it's our complete growth portfolio, 100% equities, no bonds, versus our UK bias ESG version, okay, in green on the graph. It's labeled Vantage Earth. And we've also included, I guess, a general global stock market index, and that's the black line there. Okay, so what does this demonstrate? Quite simply, the higher risk adjusted investment returns from the ESG portfolio, green, versus where we currently are today. So hopefully this should, I guess, remove any concerns, myths you may have about ESG investing and its potential on investment performance moving forward. Look, we can't guarantee we never can investment performance moving forward, but we can only look backwards, and it does provide a valuable insight. Our view is that ESG integration will deliver and ensure low investment costs. We're not getting away from that. Crucial diversification will still remain. Lower volatility, and the same, if not higher, risk-adjusted returns. Next slide, please. Okay, a bit more performance data for you. We're not looking graphically here, we're looking at cold, hard figures. The last chart was cumulative returns. This is now annualized returns, okay? So the first column, what are we assessing here? It's the same assessment. It's our current portfolio at UK bias 100 versus where we're recommending we go to. So UK bias still, but with an ESG screening there, okay? And again, 100% equities. So the return's been greater. When we've simulated the data, the returns have been greater, 7.71 versus 7.02. That's important, okay, because returns are important. We're not getting away from that. One of the other metrics that we always like to, and we have to assess, is volatility. So what volatility is inherent within getting those returns? And the data suggests that an ESG screened portfolio has lower risk, lower volatility. So the journey is less bumpy versus where we currently are. And the final column is maximum historical loss. So what are the greatest losses in a given period of time for a given portfolio? And again, the maximum historical losses, i.e. how far has it fallen, is lower. So for those principles, it makes absolute sense. I mean, when we're choosing an investment portfolio, my job is to ensure that your return is maximized given a level of risk, whilst ensuring that the maximum losses and the volatility is comfortable and aligned to your plan. And we really believe that adopting these ESG principles will deliver better value on these metrics. That is a conclusion, and that's why we're going there. Next slide, please. Okay, so how is ESG investing implemented? We remain committed to an evidence-based, factor-driven approach to investing. There is absolutely no question of us throwing out the baby with the bathwater. We are enhancing our portfolios, ensuring they remain our bedrock principles to deliver superior risk-adjusted returns, whilst placing us at the leading edge of ESG investment space. ESG is not an afterthought for us. It is not tacked on, nor is it a fad or a flavour of the month. We've been thinking about it for some time, but we wanted the evidence to suggest it's the right thing to do. We don't like to make knee-jerk reactions. We want the evidence to be there, okay? And that is why we're going there. We've negotiated with the best breed investment managers to bring this to you and to adopt the ESG changes. Next slide, please. So how is ESG measured? Okay, well, ESG, skepticism about greenwashing, the practice of appearing more ESG compliant than actually justified by the facts, has led to a development of ratings, okay, which are measurable, exacting metrics. Ratings from those Morningstar, MSCI are used in many index products, providing a numerical score which can be used as a proxy of ESG credentials. Okay, that pie chart on the right-hand side you can see, okay, illustrates the objectives and principles of ESG that companies like Morningstar and MSCI use to measure a company's ESG rating. Let me give you an example. A company may score highly on an environmental principle, an electric car manufacturer. However, from a social perspective, they may score lower. Lower employee engagement, high staff turnover. This is why we use multiple ratings, I guess, to get that overall score, because all three metrics across those various principles need to be assessed to give that overarching score. ESG measurement and ratings, it's still on a journey. We're not there yet. There's no getting away from that. And there will be significant improvements in the accuracy of the data and measurement moving forward. It's not the finished article, but it's moving in the right direction and at some speed. ESG principles have delivered additional return, as we previously looked at. Therefore, a reasonable assumption would be that moving forward, as these ratings and the data becomes more accurate, a reasonable assumption would be that there will be further outperformance looking to the future. Next slide, please. Longer term thinking. So we're still on the topic of ESG, but a longer term thinking. So investors have become increasingly sensitive to the longer term financial and environmental damage, as well as higher trading costs thought by short-termism, okay, a trend accelerated by events signaling climate change, warmer winters. Investors are more aware that sustainability through the integration of ESG can lead to a material, in brackets, monetary competitive advantage for the investments when compared to those that ignore it. Driven by investor demand to express their ESG preferences, ESG-focused funds now comprise a quarter of global assets, with more than $30 trillion managed according to responsible investment criteria worldwide. ESG is here to stay, and therefore critical that we incorporate the principles within our portfolios. Next slide, please. Okay, so we've covered ESG and what we're going to bring in there to the portfolios. The next change, alteration to the Vantage portfolios is further diversification through the factors of investing. Okay, so that's what we're going to talk about now. Factors, what do we currently adopt and what are we going to include moving forward? Next slide, please. Let's recap first and foremost. What is factor-based investing? Factor-based investing is an academic approach taken to investing where specific qualities of stocks are identified in order to improve performance. Investing in factors can help improve the overall performance of portfolios by identifying opportunities for outperformance, enhancing diversification, and reducing volatility. For a long time, we only had two factors within the portfolios, okay, within our Portfoliosense strategy: value companies and small cap companies. However, recently there has been an increase in factor-based funds, which warrant inclusion now, due to the robust academic analysis and in line with our investment philosophy. Next slide, please. Okay, first factor. This is currently adopted in the Vantage portfolios. It's currently there within the investments. The first factor of investing is size. Okay, so what is the size factor of investing? It's tilting to portfolios towards small cap stocks. Okay, and it's been inherited in our portfolios for a while now, and it's an inherent belief that we'll continue to adopt, that delivers outperformance in relation to the general market. And by small cap, I don't mean Henwood Court. I mean the lowest 15 to 20% of the FTSE All-Share, for example. Historically, portfolios consisting of small stocks exhibit greater returns on portfolios with just large cap stocks. Investors can catch a size by looking at market capitalization of a stock. In order to attract investors, small companies have to offer something in addition, I guess, to larger companies for taking greater risk. They're not as stable, they're not as incumbent. That's why, which tends to be in the form of premium returns. Next slide, please. The next factor, which is already inherent within the portfolios, is value companies. Okay. Now, what are value stocks? They're strong, profitable companies, but for some reason or another, they're unloved at that moment in time. So it's a tendency for relatively cheap assets to outperform relatively expensive ones. Value aims to capture excess returns from stocks that have lower prices relative to their fundamental value. Okay, so that is typically a book value, book cost, and that's where the return comes from. Okay, so we've covered size and value. They're inherent, and we're still going to continue to adopt them. Okay, now an example of a value company would be EasyJet, would be Cineworld at the moment. That is a value stock at present. So let's move on to the other factors that we're going to adopt within the Vantage portfolio. So next slide, please. So the first new factor of investing that we're going to recommend is implemented is momentum. So what is momentum as a factor? It is a tendency for assets that have performed well in the recent past or currently to continue to perform well in the future, at least for the short period of time. Positive performance does, for a time, attract further investment, which in itself generates further interest, attracting further investors, regardless of the underlying fundamental performance of the underlying business. The inclusion of the momentum factor increases the factor diversification and tilts portfolios towards companies that have a positive price movement over certain time periods. Academic studies have shown that companies which have done well recently are likely to continue doing so, at least in the short term. So that is the first factor that we will be adopting in the portfolios, momentum. Next slide, please. Okay, the second factor, quality, also known as profitability. So what is the quality factor? It is the recognition that profitable companies generate higher returns than unprofitable companies. Typically, current profitability provides an indication of future profitability, and companies with higher levels of profitability tend to attract greater investment, which in turn generates future increased returns. The quality factor, remember, will not be accessed via a direct quality factor fund, as several of the funds within the Portfoliosense strategy and our portfolios incorporate quality and this gives the portfolio sufficient exposure to this specific factor. So there won't be a specific quality factor fund, but within the portfolio, we're happy that we will be getting the correct and the right level of exposure to this factor of return. Next slide, please. Okay, the next factor that I'd like to cover is minimum volatility. Okay, also known as min-vol for short. The minimum volatility factor aims to improve the risk-adjusted returns of a portfolio by highlighting stocks which have historically been less volatile over time in comparison to alternative stocks in their asset class. This approach will avoid the sharper ups and downs in the market caused by other stocks, where any returns are forfeited are outweighed by the losses avoided. Minimum volatility, if I could explain it in more layman's terms, is like suspension on your car. It works by attempting to smooth out the bumps in the road and make the journey more enjoyable and potentially fractionally faster. When applied to investments, when there's a downturn in the market, minimum volatility should reduce the level of the fall and provide some cushioning by, I guess, forfeiting some of the returns generated when markets are rising. This means that the minimum volatility fund itself should not see the same degree of falls when markets are falling or rises in comparison to the other factors and the other parts of the portfolio. We are very confident that these factors will be a key component of our diversified factor strategy moving forward. Next slide, please. So you might be asking, have we lost faith in the value factor? The inclusion of new factors via the new funds will result in a redistribution of the exposure to all factors equally within the Portfoliosense portfolios. This will result in a reduction in the value exposure. There is no doubt about that, versus what we currently hold. Okay, we still see merit in holding the value factor, and we will continue to do so as long as the evidence indicates that it still meets our requirements. However, I guess with the inclusion of additional factors means we simply do not need the same, such a higher degree exposure to value, especially as other factors in the portfolios, old and new, have equal merits for inclusion within the portfolios. So moving forward, we'll still remain a significant holding in value factors, but our focus is seeking a combination of factors that best provide risk-adjusted returns over the long term and in turn achieving your investment objectives. Next slide, please. Global property. So another change within the Vantage portfolios, we've covered ESG, we've covered the new factors we're implementing. The final thing within the main changes is the removal of global property. You currently hold a global property fund with iShares in the portfolio. Our recommendation and what we're going to be implementing is that this is removed. Now, the property exposure within the growth assets is being removed. Okay, property has been included in our portfolio since 2010 due to the diversification this brought to the portfolio alongside other existing factors, value, small. However, the inclusion of additional factors, the ones we've just been over, will replace the diversification benefits of property. Okay, so we don't feel that we don't need property in the portfolio anymore. Another thing to point out, since the housing crisis and with the ensuing disruption of COVID, property is no longer viewed as a safe haven and a hedge against volatility in other markets that was previously the case. Therefore, from our perspective, property no longer meets our criteria for inclusion in the Portfoliosense strategy and will therefore be removed, with its exposure being reallocated to factor exposure. Next slide, please. So the next section of the presentation and the webinar today is who are the new fund managers. So with the changes we're adopting, we're an independent firm and we've gone out and sourced the best fund managers and the most suitable fund managers in relation to the changes we want to and we need to adopt. Next slide, please. So let's cover the first new fund manager, which isn't involved in the portfolios at the moment, but we are recommending and will be implemented that they are moving forward, is Northern Trust. So who are Northern Trust? They are the 18th largest asset manager in the world with $1.4 trillion of assets under management as of December 2020. Northern Trust has 30 years worth of experience in sustainability investing, okay, has been a pioneer in the research. Northern Trust adopts a forward-looking approach and it's got a powerful range of capabilities and solutions. Their comprehensive asset class offering includes passive, factor-based fundamentals, okay, which is inherent with our beliefs. So that's why we're going to Northern Trust, and that's who they are. Next slide, please. GSI, the next fund manager I want to explain. GSI was founded in 2011 by 4 investment professionals who each boast over 25 years of industry experience in several areas around the globe. GSI takes evidence from academic research in financial markets and translate this into sensible investment strategies. Their main aim is to deliver improved returns for investors over the long term through factor investing, which is a key part of our investment strategy. Additionally, they incorporate how companies manage their environmental, social, governance responsibilities. GSI design, build, and deliver investment strategies that have better risk and return profiles than traditional market-weighted indices. They adopt a systematic, disciplined approach, which is robust and built on academic research and practical evidence. They are long-term investors, delivering high returns for investors through diversified portfolios with high capacity, low turnover, and low transition costs. So that's GSI. Next slide, please. Arabesque. Arabesque is the next fund manager I want to talk about. Who are Arabesque? Arabesque is an independent global asset management firm at the forefront of sustainability research. Established in 2013 following a management buyout from Barclays Bank, Arabesque follows, again, a rules-based approach to stock selection, integrating ESG information with financial and momentum analysis for the firm's strategies. The firm's founding mission is to help mainstream sustainability across capital markets, and they believe economic value creation can and should be combined with environmental stewardship, social inclusion, and good governance. Therefore, through their qualitative investment approach, they eliminate human biases and are able to perform analysis at scale, integrating sustainability through their systems, enhances their information resources, and contributes to achieving better risk-adjusted returns within the portfolios. Their head office is based in London. Arabesque does operate worldwide and has additional offices in Frankfurt, Boston, and Singapore. Next slide, please. So let's conclude. Why are we implementing these changes now? You're probably wondering. These changes are an evolution of the Portfoliosense investment strategy, striving to ensure that we leave the world in a better place for future generations, while seeking to bring beneficial risk-adjusted returns over the long term. With regard to adopting ESG exposure, environmental, social, and governance, historically, one would have to accept principle over performance, with potentially increased investment risk. That was the historic view, but this is now not the case. In short, we are confident that future investment performance will be enhanced by these portfolio changes, and they'll be future-proofed. Rather than introduce changes piecemeal, okay, so make some ESG changes, then 6 months later make the factor changes, which incurs greater costs, we felt it would be more effective to introduce these changes in one go. We'll always be led by the evidence and the data, and therefore typically we also require about 10 to 12 years worth of data before we can adopt factors, ESG, other things that come to the investment world as a matter of fact. One thing to point out, as you're all on the Vantage automated rebalancing service, okay, these changes will be automatically actioned on your portfolios. There's no requirement for you to provide specific instructions, sign any forms. This will all be taken care of for you. Okay, that is the webinar today. I've just rounded that up in 31 minutes, so that's quite impressive. I thought it might have been about 45, so we've done quite well there. That is the end of the webinar. I've covered everything I wanted to cover today. We are now, sorry Peter, on to the next slide please. We are now onto the question and answer section. Okay, now there's no question and answers on the webinar at the moment. I will give participants again another 5 minutes or so to throw any questions, and then we can answer any, and if not, we can end the webinar. If you'd like to, I guess, ask your financial planner directly, absolutely do that. But we'll just wait for 5 minutes now or so, just to see if there's any questions now that the webinar has finished. So if you've got a question, type it into the Q&A box on the bottom of your Zoom accounts, Zoom application, and I'll try and answer that for you today. Okay, so we've had a couple come in, and it's around timing, which is an obvious thing that I probably didn't cover in the webinar. So good question. Let me answer that for you now. So these changes, they're not going to take place tomorrow, but we are planning, and the estimate is that they will be implemented throughout the course of June. There is no set date at present, and the reason there is no set date is we are just finalising some of the final funds in terms of register, some complication technicalities in relation to some of the funds. But I would say at some point during June, this will be communicated with you via an e-shot. Okay, so what we've spoken about today will be communicated with you via an e-shot. But in relation to changes, it will be at some point during June. But again, we will communicate with you when we have more information about that. In relation to when you'll see it on the Transact system, the Transact platform, or whatever platform that you use with Henwood Core, you'll see the changes pretty imminently. So the portfolio changes might take best part of 3 to 4 days, potentially a week to action to be finalised. So if it's the middle of June when we start them, it'll be about a week later is when you'll see the changes on Transact or whatever platform you're using. Log in and you'll see different fund managers, different funds that we're now using. Okay. Well, I hope that answers those couple of questions there. I'm just going to have a look at what else we've got here today. Bear with me a moment. Okay. So in terms of portfolio valuations, no. I mean, what will happen with the changes, that they will happen automatically. Okay. So us, along with our research partner EBI, will take care of the changing investments. Yes, there will be a period of being out of the markets, probably for 3 to 4 days. Will that result in a drop in portfolio valuations? Well, that depends where the market moves to. Remember, we're long-term investors here. We don't believe in timing markets, pulling out and going in at the right time. These changes are important. We feel they must happen, they need to happen. But whether there'll be a drop in portfolio valuations will depend on what happens with the markets. What's important is we're making these changes. They will take a few days, of course, to be actioned, to be traded, to settle. But once that happens, you will see all the funds on your platform and we can go from there. Any questions in relation to that? Again, you can pick that up with your aligned planner, but I hope that answers your question there. Costs is a couple of questions that's coming up from a few of you. So let me talk about costs there and charges, how these changes will impact. There will be a slight increase in the underlying fund management charges. Okay, so they are the fund management charges that you've got currently within the portfolio. In terms of what will be the slight increase. Now, it depends on what portfolio you're in. Okay, as you know, within Portfoliosense, we range from portfolio bond, which is no equities, to portfolio 100. Now it depends on what portfolio you're in, but the maximum increase in fund-related charges, so just the changes that are going to be implemented, the maximum is 0.04%. Okay, so a very marginal increase. That's the maximum. If you're in a portfolio with lower equity content, the increase will be smaller, so maybe 0.03, 0.02. Again, it will be disclosed to your specific portfolio in the communication we will get out to you. Okay, now I guess the increase in cost. Why is there an increase in cost? Well, ESG funds require more research, more screening, more work. Okay, they're more sophisticated, so that's the reason for the slight increase. We feel they're justifiable given the benefits they should bring. Now, remember, these increases are very small. You know, not 0.1. This is 0.04, 0.03, 0.02. But I hope that answers your question about charges. And again, there'll be much clearer communication on that in the e-shop, which will come out very soon. In terms of, is there a cost for the change of approach? Is the question I can got. So separate to the fund management cost, I've covered that. No, there's no charge or cost for Henwood Court doing the work. Absolutely not. You're on the Vantage service, and that we will take care of that for you. Okay. Let's have a look. What else is here? Just seen one here about fund managers. Oh, we are using new fund managers. Are we dropping others? In short, we are dropping some, and we are keeping some. Okay. Some of the fund managers we're currently using do not currently offer the ESG screened or factor-based funds that we need. Okay. We're constantly looking at our investment strategy, making sure it's future-proofed and it's in the right place. So in short, yes, we will be dropping some, and with others we will be keeping them. Okay. There is a question about property. Okay, so essentially, property hitting a bumpy patch at the moment. Will it not recover? Essentially, as Mark Twain said, invest in land, it's not making it. I mean, why is property being removed? I mean, for a long time we've had two such available factors, value and small, and so allocation to property was felt to be merited for diversification purposes. As it correlates with other factors, it was warranted, and that's why it was included in our diversified factor-based approach. As other factors, we've included other factors now. The initial diversification need for property was seen, I guess, to meet large degree investing in other factors. We don't feel that moving forward, property is not going to do what we need it to in the portfolio. We can do it through other funds more effectively. So it's not. I guess it is a little bit of a lack of belief in property, but there's also better alternatives, is our view there. See what other questions we've got there. So I hope that answers your question there. Okay, another question. Do the upcoming changes make the portfolio less diversified? The answer is no. The upcoming changes are not being implemented at the expense of our core principles. Low cost, evidence-based diversification. One of our core investment principles is factor-based investing. So we seek diversification among factors, as it is factors that prove empirically over many years and lead to superior risk-adjusted returns. So no is the answer in relation to less diversification with these changes. Another question. Just conscious of time now. It is 4:40. So let's see what else we've got here. Where do Transact fit into these changes? Okay, Transact are a platform, okay? Like Aviva, like Aegon, there's lots of platforms around. Transact are the technology, okay? How do Transact fit into these changes? We, along with evidence-based investors, our research partner, are the investment manager, okay? So we make the changes, Transact facilitate them, okay? So Transact enable us to access open architecture investments, okay? So we can pick these new investment managers, we can pick the old ones, we can pick different ones in the future. Transact on the technology, okay? So they have no, I guess, impact on who we're choosing, why we're choosing it. Transact is the technology behind holding these investments via collectives and where you can log on and see things, okay? So that's where they fit into the role. They are facilitating what we're going to bring in, okay? Another question, probably the final one given the time. Does ESG adoption mean you are now actively picking companies who meet the ESG required ratings? Okay, good question. No, it's still an evidence-based tracking strategy, okay? But now it's going to have a screening process and essentially exclude the worst offending companies. So it's not active. It's still an evidence-based index tracking strategy, but we're looking to exclude the worst offending companies in relation to the ESG metrics we looked at earlier. Okay, have we got any more? Let's have a look. Okay, why are you now choosing to focus on sustainability as your main portfolio proposition? Okay, again, another great question. While we, Henwood Court, I guess, and our research and investment partner, evidence-based investors, have held the notion that we wish to go to ESG for a while, the marketplace wasn't quite ready. Okay, so if there were funds available, they didn't match our evidence-based, low-cost, diversified principles. So where we wish to seek ESG, it would be at the compromise of our principles. That is now not the case. So the investment market now has the facility and the investment options available with some of the funds we looked at earlier. And that's why we've worked with these to now implement them into the portfolio whilst remaining cost effective. Okay. There are a few questions I haven't answered today. And again, apologies for that. There's quite a few on there that we probably haven't got time to get to. It's now 4:45, conscious of time that we enabled 30 minutes for this. I guess the way we'll go from here is any questions that haven't been answered, we'll take them away and we'll get an answer for you. Okay, if you've got any questions that you haven't raised today that you think about over the weekend, maybe contact your planner. Okay, contact your aligned financial planner at Henwood Court, and they will be more than happy to discuss what we've discussed here with you today and the changes. So any questions that I haven't answered on the webinar today, I'll take away, work on them and come back to you directly. Okay, and any questions that haven't been raised that again, please feel free to raise them as and when. So that concludes today. Thank you for listening. I hope you found it useful. And again, any questions, please contact your financial planner directly. Have a great weekend.